Okay, guys. So this is my first video. Um, so I give a short introduction on what the channel uh, is intended to be about, and also about what I will talk about in this video. But basically, the idea is to create a channel that goes into more detail about how businesses, especially public companies work. I realize that there are many channels that talk about now look into cash flow statements, income statement, balance sheets of companies. They do DCF models and try to figure out if the company is overvalued or undervalued, and so on. But there are almost none of these channels that talk about how the business actually works, no? And I think it's important when you're thinking about investing your money, especially substantial amounts of money in stocks, to understand how actually the company works and makes money, no? And I think that can save you from doing mistakes. So hopefully that also will be useful for anyone interested in investing. And I haven't found any channels that do this, no? So most of them are focused, as I said, on financials only. And the few pages or blogs I found talking about this are mainly focused on, like ChatGPT kind of summaries that really don't add that much value when you're researching a company. So I wanted to do a channel that it's not so focused on looking at the financials, but understanding how the company works. Obviously, we will review some financials, but that it's not the main goal. And I think there's plenty of content online if you want to do that. And yeah, just a few lines on me. So I'm not an economist or a CFA or anything like that. I have a scientific background, but been investing in private companies in venture capital for more than 5 years. And thanks to that, I've seen many different business models of companies trying to make it. I've seen which ones succeed and which ones not. So hopefully that also gives me some edge when looking into public company business models. With all that being said, let's jump right into it. So today we'll discuss Pacific Biosciences. Pacific Biosciences is a public company based in the US, listed in the Nasdaq stock exchange, and it's in the industry of biotools, I would say. And yeah, what I think it's relevant to understand first is that the company was actually founded in 2002, received a lot of venture capital funding back in the day from SoftBank and other well-known VC investors. IPO'd in 2010, and as you can see, since the IPO, the stock price hasn't improved much, so it's been mostly flat since then. Actually, it's still 94% below the IPO price, more or less, with a market cap of $340 million. Actually, the price went a bit crazy during the COVID days because what they do, basically, the main business model is selling sequencing devices, no? And sequencing, it's very often used in diagnosis of many diseases, including viral disease like COVID. So I guess they got some of that hype from COVID, and the stock price spiked, and they actually took advantage of that to do some mostly stock-based acquisitions. They acquired three, I would say, relevant companies in the last years. One of them is Circulomics, which is mainly the reagents business. So they sell the materials you need to run some basically different types of tests. In this case, sample preparation for sequencing, and then they also acquired Omniome and Aptom, and these were mainly technology acquisitions because they wanted to enter in a subset of the sequencing market, which is short read sequencing, which we'll discuss later, and their original technology was for long read, which is the other let's say subset of the sequencing market, no? So they wanted to expand into this other subset, which is bigger, and that's why they acquired these two companies. And that's mainly the points that I wanted to get across at the beginning. As you can see, the revenues are in the range of 150 million, and this was last year, and geographically distributed across America, Asia, and Europe, which is good. It's not necessarily a green flag nor a red flag, but yeah, they have clients all across the world. And that's it. Let's look at how they make money. No? So basically, they have three different sources of revenue. The first one is they sell the instrument to do the sequencing. No? So in order to sequence anything, you need an instrument, and there are different technologies, no, to do this. They have their own unique technology for long read sequencing, and they have two devices that they are selling to do long read sequencing. The Review device, which was launched in 2022, and previous to that they had other versions, like less advanced versions of this called Sequel 1 and Sequel 2, but these are mostly phased out. So the main product for the last few years has been the Review device. At the end of last year, they also launched a benchtop version, so a smaller version, cheaper of the Review device, called Biga device, and this was at the end of 2024. And as you can see, the price it's much lower. And then also in 2023 they launched, and this was also the result of the acquisitions I just discussed. They launched a short read device, which had, I think, so far very limited commercial success. Then this is I would say, one of the more relevant parts of how they make money. So they sell the device to either research institutions that go anything from research centers to universities all across the world, and also commercial and clinical labs of pharma companies or clinical lab companies that run basically tests for as a third party for clients. No? So they buy the devices, and then they utilize those devices to run tests that are ordered by hospitals, let's say. No, and these are the two main buckets of clients that they have. Once they sell the device to one of their clients, there comes probably the most, I would say it's the most important source of revenue that they have, and what makes this type of companies interesting. No, it's the consumables, and they sell consumables that are custom, tailored for their own devices. No, so when you buy, for example, the Review device from them, you have to use the consumables on a daily basis to run tests on this machine that they are selling to you. So you are locked in. No? So you buy the device, you may spend, in this case, 0.8 million in this huge device, but then on a yearly basis you spend also substantial amount of money buying all the materials you need to run the tests, because you cannot put the sample directly in the device and get the results. There are a series of steps that you need to do to prepare the sample, and also to run the test in the machine. No? And these materials, these reagents, are the consumables. And then the third source of revenue is the service and maintenance fees. No? And these are basically, you need to think that these machines are quite complex. They need to be maintained periodically, and they are super expensive. No? So you want to keep them well maintained so they do not break down, and you have to buy a new one. And this is another source of revenue. This sometimes is offered directly by the company selling you the device, but there are also sometimes third party companies that also can maintain you the device and offer cheaper services. But basically what it means is that you have a person, you pay an annual fee, and you have a person that if anything happens to the machine comes and fix it, or if nothing happens, just comes to making sure that the machine is working properly, and that's the typical maintenance. No? So these are the three main sources of revenue. The more relevant ones are the product or instrument revenues, and the consumable revenues. Service and maintenance fees are not negligible, but usually not so relevant. And in reality, how these companies make the money with the consumables, no? Because you need to think that when you pay a substantial amount of money for one of these devices, you are locked in as a customer, because you don't want to buy, then switch to another company and again pay the full amount for a new device, but rather just keep the same device and keep using that. So you need to keep buying the consumables from the same company that sold you the device, and usually consumables are not cheap, and they have a high margin for the company that is selling them, in this case Pacific Biosciences. They are also recurrent and usually easily forecasted into the future. No? So it's high margin, recurrent, predictable revenue that you generate from each device that you sold if it's being used. That's an important point, as we will see later. No? So if the device is being used, you generate not only the initial sale of the device, but there's a, let's say, lifetime value to that initial buy of Revio, Biga, or Onso, no? All of them. I think that's mostly it on the broader the broader aspects on how the company generates revenue. Let's try to understand a bit better how the company is positioned in the market versus its competitors, and in which market it plays a role. No? And here I prepared a very simple explanation and example, actually two of them, so you can understand the sequencing market. No? The sequencing market, it's, as I said, basically there are different use cases, and anything from diagnosing viral disease to diagnosing what type of cancer you have, to many research use cases like assembling a genome from a new bacteria from scratch. All of these are use cases that you need a sequencing machine to do. No? And the thing is that there are two main types of sequencing. One is, as I said, short read, which is the more widely adopted and generally has higher throughput and accuracy and lower cost. And the other is long read, which is a more complex type of sequencing that therefore has more niche applications and a smaller market than short read. And as you can see, some of the examples I listed here, it's discovery of new genomes, mutations that extend across, like you need to think of a genome of a very, very long string of characters, no? And if you need to identify patterns that happen across very long distances in this string, you need to be able to sequence big pieces at the same time, no? And that's where long read sequencing excels. No? And here's some analogies, no? But if we imagine the genome, actually there's an important point here that I missed, no? Because when we are sequencing a genome, obviously the genome is assembled when it's in a living thing, in one of our cells, bacteria or virus, but as a part of the sample preparation for sequencing that genome, we always break it down into pieces. And here it's where the main difference between long read and short read comes in. When it comes to short read, we are breaking these in many small pieces and detecting these pieces. So it's akin to reconstructing a puzzle with many small pieces, whereas in long read, we try to reconstruct this puzzle with bigger pieces, no? Which is it's easier, but also it's more time consuming, and usually also it's higher cost. Another example to try to understand better the differences is, let's say, for example, that I give you this sentence, no? Let's imagine the sentence, it's a genome. I know it's a big simplification, but it works similar like that. No? I give you this sentence and I tell you, okay, let's break it down into pairs of 2 or 3 letters and try to reconstruct the full sentence, or let's break it down on pairs of 2 or 3 words. No, it's much easier to have a accuracy or to actually assemble this sentence back together from scratch using big pieces than using small pieces. No. And this is the main difference between long read and short read. In long read, we're using big pieces, so it's much easier to assemble end-to-end the genome, while in short read, we're basically looking for, rather than trying to reconstruct the full genome, we are looking for smaller patterns in the data that we're able to just understand by using smaller pieces, no? And then the other factor that is important is the accuracy, no? So as with all tests, this is not 100% accurate, no? So we don't know for sure that this is brown fox. There is a probability that this is brown fox, but there's also maybe a probability that it's red fox, because there is not a single device in the world that has 100% accuracy, no? So we are always playing with the amount of accuracy that we can get, and this introduces another variable that it's important, especially depending on the use cases, no? Because there is, depending on the use case, we can accept the higher or lower margin of error. So I hope this gives you a bit of a overview on the difference between short read and long read. In summary, basically, it's 2 different types of sequencing. Short read, it's much widely used because it has, I would say, use cases with higher volume, and long read it's more complex and has use cases that are more niche and advanced, and it's less widely used. Now, if we look at how Pacific Biosciences, PacBio, it's positioned against all the other players in the space when we think about type of sequencing and accuracy, we can see that the sweet spot where Pacific Biosciences excels and has no competitors, it's for use cases where we need a high accuracy, and also we need long read sequencing, no? These are some other examples besides the ones I mentioned before, but it's methylation patterns. Also for early stage research, it's quite important. And then for structural mutations, which are usually related to rare disease diagnostics. So this is like the sweet spot, no? The market where Pacific Biosciences is the number 1 option to go for, no? And in this market, they have Revio and bigger devices that I mentioned before. They also have, as I said, this new device for short read sequencing that they launched, I think, in 2023, the Onso device. So I also put them here, but again, this had very limited commercial success, so not sure how relevant it is, no? And then if we broaden the scope, especially when you go into the short read sequencing, the market, it's, as you can see, it's much more crowded, and some of these names will ring a bell probably. Illumina, it's the leading player in short read sequencing. There's also this Chinese company called MGI. Thermo Fisher also does some short-read sequencing, although their tech it's not super good. And then there are some private companies like Ultima Genomics, Element Biosciences, and Singular Genomics that was actually recently taken private by a private, I think it's a private equity firm, or well, an investment group, Deerfield. So as you can see, the main idea here is that short-read it's a much more crowded market, where Illumina is leading and has probably most of the market share. And then in long read, the main competitor of Pacific Biosciences is Nanopore. No? So there are only two relevant players in long read sequencing, which is Pacific Biosciences and Oxford Nanopore Technologies, which is a spin-out of Oxford. It's a UK-based company that is also public and traded in the UK, in the London Stock Exchange. And the main difference between Oxford Nanopore and Pacific Biosciences is that the Oxford Nanopore devices are usually much cheaper, at least historically, than Pacific Biosciences, but their technology, because they are using totally different technologies to do the sequencing, it's not so accurate. No? So Oxford Nanopore usually excels at use cases where you need long read, but you don't need high accuracy, because their devices are much more portable, much more cheaper. So if you don't need the accuracy and you need to do long read, you usually go for Oxford Nanopore. Otherwise, if you need higher accuracy, Pacific Biosciences it's the way to go, no? And I think that's mainly that. Probably I've missed a few companies, but this is more or less the landscape of the different types of sequencing with different public and private companies. Let's move to product sales, which I think it's quite relevant. So these are, as I mentioned, currently Pacific Biosciences has three main devices. The main one has been Revio, which was it's this dark green, and these are by unit sold compared to overall gross margin of the product mix. And as you can see, most of the sales in the last 2 years, I would say, 2.5 years, were coming from the Revio device, and before that, these are the previous versions of the Revio device, which were Sequel 1 and Sequel 2, but overall, basically they switch. So Revio is an improved version of these older devices, and as you can see, it has taken over new device sales. And as I said, Onso it's the short read sequencing device, was launched at the end of 2023, and the reason I think it didn't have so much commercial success is because all this data comes from the investor reports of the company. They do not list the amount of units sold for Onso, and also I believe the market, as you've seen, is super crowded. So in any case, I don't think that commercially this was a super success. What I think is interesting is the bigger device that they launched at the end of last year in 2024, and as you can see, it's already picking up on sales. And the bigger device, it's the benchtop version of Revio. And as you can see, it's already generating substantial amount of sales, and even I would say replacing. What we can guess from this graph is that already it seems like Biga it's somehow replacing sales of the Revio device, and also this is also reflected on the gross margin of the product mix. As you can see, the Revio device it's much expensive and therefore has a higher gross margin than Biga. So when we are switching the product mix to higher number of sales of Biga, the gross margin it's decreasing, at least until they streamline manufacturing and they can get that gross margin up. Another fact decreasing the gross margin is, I think, the initial price point of review, which was 0.8 million, has been reduced because they were probably struggling to sell enough units. And yeah, I think this is all regarding the product mix. As I mentioned, the main point is Vega. It's selling well, seems to be selling well, but also at the same time replacing sales of the review device, which not only has higher margin, but also has higher, if used fully, and that's an important point, has higher consumption of consumables and therefore also drives higher consumable usage and increases the revenues on the consumable business line that we discussed before. Let's look at the revenue by the three components that we mentioned before. No? So we said that when they are selling the initial device, that's instrument revenue. All the materials and reagents that they are selling after selling the initial device to the same customer, so he can use it on a daily basis, it's consumable revenue. And then the third and less relevant, as you can see also by numbers, revenue line, it's the service and others, which this is basically maintenance and service fees that they are charging on devices sold. No, so the main point here is that the number of units sold in the instrument business line increase the total installed base of devices that later drives revenue in the consumable and service and other business lines. And where the company has as I mentioned before, the recurrent, high margin, predictable cash generation, it's in the consumable service line. If we look at the revenue by segment, actually you can see that consumable it's increasing as it should be, because this is in a way cumulative. No? So each new device sold adds to the current installed base and increases the total consumable revenue. However, already looking at this graph and these numbers, what I guessed is that consumable revenue should be even higher than it is now. And as you can see, during last year, it was already higher than instrument revenue, just to portray how important this business line or revenue source is, let's say. But it's still, looking at this, I think it should be even higher, taking into account the number of devices they sold in the last 5 years. So the next type of analysis that we can do here is we can look at the total consumable revenue per device sold and service revenue per device sold. No? And this is, here we had to do a bit of an approximation because this data it's not always disclosed in the investor reports that they do. But looking at historical data, I think I got a quite reliable approximation of what's their installed base. No? So here we have devices sold every year, and then on the second row, and this is the interesting part, we have the total number of devices sold cumulative, or the installed base, which is the same. And this should be the total number of devices that are generating consumable and service revenue. So knowing this and knowing the total revenue per consumable and service per year, we can approximate by a simple division how much consumable revenue is generated every year based on the total installed base. No? And this is also what we can see in the graph. the installed base, it's growing every year because we are adding new devices to the market, and the existing ones are still generating consumable and service revenue. So the installed base, it's growing, but the consumable revenue, which is as I said, and I want to drill on this point a lot, but this is the more relevant part of the business. The consumable revenue per device, it's not increasing. So it's actually decreasing since 2020. This means that the new devices sold are being used less, or are consuming less materials, this means the same, than before. No? So each new device sold in the last 5 years is generating less consumable revenue. Therefore, it's being used less. This means that something is happening, no? And there can be, I would say, many different reasons for this. The main one is that the customers that bought the initial device are not finding a reason to use it that much. So they don't have enough volume of samples to put through the device to keep consumable revenue per device at least flat, and it should be actually increasing. Why it should be increasing? Because this graph also includes, as I said before, no? If we go to product sales, two main devices. It includes older SQL devices and includes newer Revio devices. No? As you can see, we only started selling Revio devices at the beginning of Q1 23. And there's an important point here, because the Revio devices, the Revio system, has the potential to consume 4 times more consumables. So it can run 4 times more samples than older SQL devices. Therefore, if these new devices, the new Revio systems that was launched end of 2022, beginning of 2023, is being used at full capacity, consumable revenue per device should be increasing, but it's still decreasing or flat. So it means that even though the company is managing to sell these devices, they are not a good they are not finding good product market fit, let's say. No, so clients are buying this, but they don't really need to buy a device that has 4 times the throughput, because they are not using that increased capacity. So in a sense, they are not making a good buy, and that's dangerous, no? Because it means that consumable revenue, even though we have spent a lot of R&D, marketing, etc., on new devices, it's not increasing. It's decreasing or staying flat. So this is, I would say, for me, the main point of concern with this company. Are the devices actually being used and adding value? Or could the customers have gone with another option and solve their needs without paying, $800,000 for one of these systems? This is one of the main questions and concerns, I would say, for the company. However, I think that the new bigger system that they launch has much better product market fit. And in a way, we already, if we go back to the product sales analysis, unit sales, we can already see this. Sales have picked up quite fast, and we were already suspecting, no, that that some of the sales of Biga were replacing sales of Revio. And that makes sense, right? Because let's say that you need a sequencing machine that does long read and high accuracy. Okay, then you have to go with PacBio, Biga or Revio system. But you don't actually need the high throughput of a Revio system. You don't need to run that many samples. The moment you have a cheaper option that has the same accuracy and can also do long read, you switch. Why are you buying something that you're not going to use, right? And this seems what it's happening. And this could be good and could be bad. Could be also bad, no? Because the bigger system has lower margin. So let's see, how that plays out. On the other hand, probably many labs that could not afford the Revio device will now be able to afford the Biga. So on the other hand, the Biga system, it's probably going to make the market for Pacific Biosciences bigger, no? And I think this is the wild card that this company has, that the Biga system could actually increase the current market size that they were targeting, no? Even though it's probably going to use less consumables per device. But we need to wait to see that for sure, because this was launched at the end of 2024. We need more data to see how this is playing out. But yeah, so looking at this, and here, to put everything in context, what we are doing is we are comparing all the devices from Oxford Nanopore, which is the other player in long-read sequencing, with the two devices that Pacific Biosciences has for long-read sequencing, which are the Biga and the Revio device, as we explained, no? And what I think is interesting here is that if we look at the Biga system, it's competitively priced against the Oxford Nanopore devices that have similar throughput. And I think this is interesting, no? Because as one of the points we made at the beginning is that Oxford Nanopore, what they had as an advantage is that they offered lower prices in general. Less accuracy, but lower prices, no? But with this new device, Pacific Biosciences actually has similar pricing, similar throughput than Oxford Nanopore devices, but higher accuracy, no? So it's another reason to think that the biggest system may even take share from some potential or legacy clients from Oxford Nanopore that they were not able to capture before. Again, how big is this market and how big is this opportunity? It's another question, no? And that needs to be related to valuation and so on, no? But it seems like they could obtain part of this market. A minor point is that Oxford Nanopore devices are probably also more portable, and even though Biga it's a benchtop device, I think it's much more bulky than Oxford Nanopore. But I don't think this is a key factor in key purchasing criteria when deciding one over the other. It's important, but the fact that you can do super high accuracy and still have a sensible throughput and price, it's much more relevant. And actually, the third point here, and this is also interesting, is that I think the bigger device could even be used as a single device for both long read and even could steal some use cases from short read sequencing technologies. And I don't know how big this is. I don't think it's super big because Illumina is very well established, it's very cheap, cheap and it's very high throughput. But I think there are some use cases that the bigger device could actually take from short read technologies like Illumina. And these are cases where you need high accuracy also, but you don't need a lot of volume or throughput, no? In these cases, instead of having one, let's say you have a lab, no? Instead of having one bigger system and for long read and one short read system from Illumina, if you don't have big volumes, since the initial prices already for Illumina benchtop and bigger system are also in a similar range, you could just buy the bigger system and basically go with a single standalone sequencing machine instead of two. Again, this is supposition, but I think this is something that could happen, and it's also interesting. So I think the wildcard, in summary, for Pacific Biosciences, it's the bigger system, no? Okay, let's do a summary of everything we discussed. So, strengths of the company, unique technology, no? So their long read sequencing technology, it's proprietary. They have all the IP, and this has value. Now this is an asset. Because no one else has this technology, so this, it's like, let's say, a balance sheet asset for the company. Even in case of acquisition, this is certainly going to be valued, and this technology again works really well for some use cases. The other question is how big these use cases are, but structural variants, microbial genome assembly, even doing quality control for manufacturing of viral vectors could be interesting. Second point. No? So again, a bigger benchtop device could actually be a commercial success. Not sure how big, but could give the company let's say a long-term solution for many use cases where it would be very difficult to displace them, and this is important. And this is also coming back to the first point, but I think many big players, especially Thermo Fisher, which will probably make an acquisition in the sequencing space sooner rather than later, could be interested in the platform that Pacific Biosciences bought. Let's take a look at the risks. So number one, and this is the big question, it's unclear how big the market is for high accuracy long read sequencing, and it's unclear how much more the company could grow. But this is more a question of valuation rather than anything else. If the valuation is right, if they're able to be profitable and generate cash flows from these use cases at the right valuation, it could be interesting. Especially if the bigger the benchtop device, it's a success. So if the bigger benchtop device is a success and we can track this going forward, how it's performing, and the valuation is right, the company could potentially be interesting. But let's jump to the other risks. Product portfolio is too wide. So they have too many things. They have all these acquisitions on the Onso device for short read sequencing. They should just drop everything and reduce costs, in my opinion, because entering the short read space directly, I mean, we've seen the numbers. The Onso device, it's, I don't know what are the numbers of product sales for this, but probably not super high. The other risk, so Oxford Nanopore, obviously it's not going to stay still and see how the Pacific Biosciences guys potentially even still part of their use cases with things like the big venture device, they are going to keep pushing and improving the accuracy of their own low-cost devices. And this is also potential big risk. Probably both technologies can coexist, but in the long term, this is certainly a super relevant risk. And then the fourth risk, and this is more related to macroeconomic conditions, is that, as we've seen at the beginning, many of their clients here are publicly funded, and these are funded by grants. So many labs, like universities and so on, use grant money coming from the government or from the NIH and so on to buy these devices. No? And we have already seen in the news, probably, if you're looking at this video, probably are paying attention to this, but that Trump already has cut some of this funding to universities, and there's a lot of uncertainty in this. So this is also something to take into account, that a lot of public money it's going indirectly to fund this company's revenue. And if the government, either in the US or in any other country, decides to cut in funding into research, these guys are going to feel it. And I don't think it's going to be pretty. And this is, for me, also quite relevant risk. Let's go to the final recommendation. So final recommendation, as I mentioned, the key to this company in the end is the consumable revenue, high margin, highly predictable recurrent revenue, and the ability to keep their customers locked in. And this is why actually seeing that the customers are using the device, it's important, no? Because if they are using it to the full extent, they are happy with it. If they are happy with it, they are locked in. So this consumable revenue, it's gonna get coming for a longer period of time going to the future. Here, the back of the envelope calculation, just looking at consumable revenue for the company, which was 70 million last year, and assuming a 10% growth rate and 50% gross margin on the revenue. And then I've been super generous and applied the next multiple on the recurring revenue coming from consumables. And actually, it's funny because this more or less gives us the current valuation of the company. And I think this is super generous because the company is obviously losing money, but let's imagine for a second that we stop selling new machines, we cut costs to the bone, and the only thing we do is sell consumables to the existing install base. And that somehow, in a combination of inflation with increased usage of these machines, we're able to increase consumable revenue by 10% per year, which is already a lot, but let's assume that. This would be the only revenue coming in the company, but it would be almost not software-like, but almost software-like revenue. So therefore, this revenue deserves a very high multiple, or not very high, but at least much higher than the instrument initial sale revenue. And even then, it's not like we are coming up with a valuation that it's super different from the current one, or much lower or higher. So in the end, final recommendation would be for me, I would not invest in this company right now. I think there are too many incognitas, and it could be interesting, depending the valuation, in the future if the bigger system does very well and the gross margin improves, if management is able to reduce all other costs and they best, to be honest, technology that does not make sense. And also to see, I think it's worth keeping an eye on future sales of the review system, because I think these are going to be lower than historically. If my hypothesis is correct, then people were only buying review because there was no other option, no other cheaper option with similar specs. But now that you have bigger, this probably changes, and yeah, let's see how this affects consumable revenue going forward. But in any case, I would certainly wait. There's a lot of embedded risks and incognitas here, and I think probably 2 or 3 quarters from now we'll have much more data on bigger sales, and hopefully management would have cut or divested anything that is not related to review or Viga, which should be the only 2 assets or two products that this company is focusing on. And I think that's about it. I hope this was somewhat useful, and yeah, let me know your thoughts.